Where's the best place to be born at present? Because where you're born will make a big difference in your life, in your lifestyle, the amount of wealth you can get, your health you're going to have. And that's one of the things we're going to discuss in today's episode of the Michael Yardney podcast. And for people interested in property investment, John Lindeman has got a great cash flow surprise for you. And in my mentorship moment, I've got a lesson for you from one of my mentors. But why are we talking about the best place to be born? And even if you weren't born there, a great place to live is Australia. And I know a large number of you listening to the show right now are in Australia. Interestingly, the old rivalry between Melbourne and Sydney is going to continue because both bagged perfect scores in the recent EconomistIntelligence Unit's Global Livability Index. Once a year, the EconomistIntelligence Unit measures 140 cities to find the most livable city. Melbourne, which the report says attracts tourists for its classical music scene and imperial history, and also has abundant green spaces and excellent public service, last year ended its 7-year run as the top city in the survey. So for 7 years in a row, Melbourne was the top city. This time, Vienna pipped it by 0.7 of a point out of 100. Now, all great cities, by the way. I've got a soft spot for Vienna. My mother was born in Vienna. My maternal grandmother was born in Vienna. Lovely city. But we're lucky that we live in Australia. And in the rankings this year, Melbourne came second. Sydney came third, moving up from fifth spot. Adelaide number 10. And Brisbane and Perth came in the next 10. So 5 big capital cities in the top 20 cities in the world. Isn't that great? Sydney this year rose to third spot from fifth spot due to an improvement in its culture and environment score. However, the report poured cold water on Sydney's prospects of overtaking Melbourne. It said, with both cities already scoring really highly across all categories, there's only limited potential for Sydney to displace either Melbourne or Vienna at the top of the rankings. Doesn't matter. We're in the best place in the world at the best time in history. Yet why do so many people feel miserable? That's what we're going to discuss in today's show, plus some great information from property researcher John Lindeman. So welcome to this week's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the 5th time he's won a similar award in the last 7 years.
Warren Buffett, arguably the world's most successful investor, once said that anything good that happened to him could be traced back to the fact that he was born in the right country, the United States, and at the right time in history. At that stage was 1930. Of course, what he says is true. Back then America was the place to be. But where's the best place to be born today? And how can you decide? Well, one place to start could be the EconomistIntelligence Unit's Best Countries to be Born report, which attempts to measure which countries are going to provide the best opportunities for health, for safety, for a prosperous life in the years ahead. And they considered factors like GDP per capita, life expectancy, unemployment, gender equality. Well, last time they ran this report, Switzerland was the answer, was the best place to be born, but it was followed very, very closely in second place by Australia. While not surprisingly, Nigeria, Kenya and the Ukraine were at the other end, the bottom of the list. The Economist, in its report, found that being rich helped people's happiness. But it wasn't the only reason. They also found that important factors were crime, trust in public institutions, the health of the family, life, all those sort of things mattered. According to the 2019 World Happiness Report, there are 3 important factors to finding happiness. These include relationships, money and health. And this report, which by the way found Finland to be the happiest country in the world and Australia was number 11, this report agreed that money does make for happiness, but only to a point. And that's clearly right. Money is important in those areas of your life where it's important, like paying the bills and paying the school fees, and it's not at all important in other areas of your life. But if you think about it, any problem money can solve isn't really a problem, is it? So how wealthy you are definitely has a lot to do with living in the luckiest country in the world. And if you're living in Australia, you are living in the luckiest country right now, and it's about to get a whole lot better. Despite all the headlines about the risks imposed by levels of debt or poor property values or our slowing economy, the latest Roy Morgan Wealth Report revealed a very, very positive outlook for the long-term trends for Australia. Australia's performed very well according to the report over the last 12 years since the global financial crisis, particularly compared to other developed countries, the OECD nations, particularly Europe if you think about it, where many nations went backwards over the same period. Since 2007, net wealth per person in Australia has increased 65.1%, and there were gains across all levels, the wealthy and the poor. Not surprisingly, half Australia's personal wealth, roughly half of it, is in the form of owner-occupied homes, 49.8% according to the report. This is down slightly from a decade ago when it was just over 51%. The other big asset that most Australians have, and it's becoming an increasingly higher proportion, rising from 19.2 to 25%, 24.4% actually, is our superannuation. The Roy Morgan Wealth Report found that the wealthiest 10% of Australians, with an average net wealth of over $2 million, and that's up from $811,000 in 2007, the wealthiest 10% hold 47.9% of the net wealth. And the poorest 50% of Australians, with an average of $31,000 in assets, up from $11,000, who, despite gains, have seen their total share of net wealth fall from 3.9 to 3.7. So yes, the rich are getting richer in Australia, but not that much. The total wealth of the poorer people dropped 0.2%. Now, again, everyone's got the opportunity in Australia to become wealthy. I genuinely believe that. That's not the case in other countries. We're so lucky. But what's going to happen moving forward? In 2019, the Global Wealth Migration Review report showed that as far as developed countries go, Australia's outperforming the others, and Australia is expected to add 80% to private wealth held by individuals in the next decade. That means 80% increase in the average Australian's wealth in the next decade. And in the process, we're going to leapfrog both Germany and the United Kingdom in rankings to become the fifth wealthiest nation in terms of private wealth held by individuals. So all these figures I'm telling you about people's own private wealth, not government wealth, not assets of the big companies, but it's things like property, cash, equities, business interests, minus their liabilities. Now, clearly, our geographic neighbours, China, where wealth is going to grow 120% in the next decade, and India, where it's going to grow 180% in the next decade, they're going to outpace private wealth growth. But they're still, in many ways, developing nations. We're going to grow faster than any other developed nation. And if we play our cards right, this is also going to provide us with a great opportunity because of where we are geographically. We can provide China and India and the other developing Asian nations with natural resources, with education, with health, with technology. And there's a real opportunity for our tourism industry to flourish even more. If we get it right, we could be the playground to a rich new middle class of Asians. I remember back in the 1980s, we were the preferred holiday destination of that new class, wealthier class of emerging wealthy class of Japanese in the 1980s. Let's do it again. But having said all that, we're glum. Why? Australians, and particularly property investors, seem to have lost their mojo. Sure, general consumer sentiment is improving, but consumer sentiment's been low for some time, and many potential property investors they're sitting waiting on the sidelines, waiting for somebody to ring the bell confirming the market's bottomed. And they're being fed by a media who in general has forgotten that we are the lucky country. They forget that as a nation of around 25 million people, we punch well above our weight. We're the world's 14th largest economy. And if you ask me, I think we should get bonus points for our low rate of unemployment. While some complain that when this creeps up, 0.5% or so, it's still around 5%. And compare that with Italy, where unemployment is double that, or where Spain, where it's 3 times our level. So the message I want to share with you today is Australians tend to take many things for granted. Yet despite all our challenges, in certain respects, times have never been as good for us. Yeah, our economy is a bit slow, it's in second gear, but it's not in reverse like other places. Our political system is solid, our banking system is sound, income levels are at or near historic highs, and our life expectancy continues to increase steadily. We should feel very lucky for the situation we find ourselves in, and naturally, being a great place to live is strongly positive for our property markets. Quibblers will of course find more holes in my argument there are in a chunk of Swiss cheese. There's always going to be plenty of property pessimists around. However, the fact is, as Australians, we've got every reason to be proud of where we live, and we've got every reason to be excited about our future, including the long-term health of our property markets. That means, as I said earlier on, anyone in Australia who wants to can get rich. Most Australians haven't inherited their wealth. They've become financially independent by getting a good job, working hard, but then in saving, spending less than they earn, and investing in residential real estate. As the reports I've showed you show, more than half our wealth is in residential real estate. So why don't you take advantage of the great counter-cyclical opportunity we're currently in? Property values have dropped considerably in our two big capital cities, Melbourne and Sydney, the likes of which we didn't see a decade ago in the global financial crisis. So this is really the best counter-cyclical opportunity in decades in Melbourne and Sydney, and a great time to ride the property wave in Brisbane. But if you're careful, you're going to do well, and if you buy the right properties, they're going to increase in value because the wealthy people in our nation, and you've just found out there are going to be more and more of those, are going to want to buy those properties. But not all properties are going to go up. There's not one Melbourne market or Sydney market or Brisbane market. If you want to know which sort of properties are going to be the right ones for you, if you're looking for advice, whether you're a beginner wanting to get going or you're an established investor wanting to understand what the next steps are, why not allow my team at Metropole to help you? Remember, we've got no properties for sale, but we've been involved in over $3 billion worth of property transactions, helping our clients grow wealth for decades now. So my suggestion is go to metropole.com.au, leave us your details, and have a chat with our team. You may just need a $29 book. We'll probably even gift that to you. You may require a strategic portfolio review or a strategic plan built specifically for you so you know what's possible. And then you may want to use our buyer's agency services, property management services, development services. We get involved in medium density project development, managing it for you, and renovations as well. Go to metropole.com.au, have a chat with my team. I look forward to being part of your wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Many years ago, my mentor, Jim Rohn, taught me that life is worthwhile if you use 4 powerful little words. These words are learn, try, stay, and care. What a difference you can make to your life by putting these words to work. Jim Rohn taught me that, first of all, life is worthwhile if you learn. If you know. What you don't know will actually hurt you rather than what they often say, what you don't know won't hurt you. You have to have learning to exist, to grow, to succeed. Life is worthwhile if you learn from your own experiences, both negative and positive. We learn to do it right by doing something wrong the first time. We call that a positive negative. We also learn from other people's experiences, both positives and negatives. Jim Rohn always said it was too bad that failures don't give seminars. He said we don't want to pay them so they don't go on tour and give seminars, but the information they would give you would be very valuable. How somebody who had it all messed up. Learning from other people's experiences and mistakes would be very valuable. We learn by what we see, so pay attention. By what we hear, so be a good listener. Now, I suggest, though, you become a selective listener. Don't just listen to anybody dump into your mental factory. We learn also from what we read. Learn from every source that you can. Learn from podcasts, learn from lectures, learn from conversations, learn from people who care. So I guess the first part of this lesson is always keep learning. It's one of the rich habits, the success habits of all wealthy people. Jim Rohn then went on to say, life is worthwhile if you try. Remember, he said there were 4 really powerful little words: learn, try, stay, and care. So life is worthwhile if you try. It doesn't mean you can do everything, but there are a lot of things you can do if you just gave them a try. So try your best. Give it every effort. Why not go all out and give it a go? Jim Rohn also said life's worthwhile if you stay. You have to stay from spring to harvest, he said. From the beginning to the end when you reap the rewards, I guess is what he was saying. So if you've signed up for the day or for the game or for the project, see it through. Sometimes calamity comes and it looks like it's worth just wrapping it up, but that's not the end. It's only the middle. Maybe the next project will be better, so stay on this one. If you signed up, see it through. And that is definitely one of the success traits of the wealthy people, the successful people, the rich habits. They actually stick to it, they see it through. Remember, Jim Rohn was teaching us about 4 powerful words: learn, try, stay, and the last one was care. He said life is worthwhile if you care. If you care at all, you're going to get some results. If you care enough, you're going to get incredible results, he said. Care enough to make a difference. Care enough to turn somebody around. Care enough to start a new enterprise. Care enough to change it all. Care enough to become the highest producer. Care enough to set some records. Care enough to win. Some great words from the late Jim Rohn. Life is worthwhile if you put these 4 words to use. Learn, try, stay, and care. Now, there are 2 schools of thought in property investment. Some people believe you should invest for capital growth. Others talk about investing for cash flow. Now, those of you who've read my blogs, listened to my podcast, know I'm firmly in the capital growth camp. But I do understand the importance of cash flow. Cash flow keeps you in the game. It helps pay the mortgage, and capital growth is what gets you out of the rat race. But recently, rents haven't risen, not much, while the market's actually been flat. That's a bit different to what normally goes on. And now, even though the property market seems to have turned, we're not going to have a boom for some time yet. That's just not how the market works. We're not going to have another boom straight away. So to understand what's ahead and what could come to the rescue of property investors, I've got with me John Lindeman, who's widely respected as one of Australia's leading market analysts. Look, I know John's had well over a decade of experience researching the nature and dynamics of various assets, and John's renowned as a market researcher, writes regularly for your investment property magazine. He's got a great website, Lindeman Reports, and clearly he also regularly writes for Property Update. So welcome, John.
Thank you, Michael, and welcome to everyone as well.
Now, John, you recently wrote a great blog that we published on Property Update as well, suggesting that cash flow is going to come to the rescue this time. Hasn't really worked like in previous cycles where during periods of lower capital growth, rents increased this time, did they?
No, they haven't gone up, and actually, yields are now at their lowest that they have been for a long, long time. It's definitely time for something to move.
Well, it's interesting. You and I are old enough to remember when yields were around 10% with residential real estate. But at that stage, inflation was higher and interest rates are higher. So relative to other investments at the moment, cash in the bank or other things, with interest rates being low, I guess you don't expect the yields to be that high. But they are at historic low figures, aren't they?
They are. And the average gross rental yield over the history of Australia is about 11.2%. So you can see at the moment it's 4.3%. Really, very much lower than it has been on average.
Now, what you were suggesting is that, in fact, the yields are the lowest it's been for a long time. Why do you think that is?
I think that although we haven't, when you look at the long-term growth of house prices, it hasn't been phenomenal, but it's been steady. We've had steady price growth, and that's occurred, because housing has become more affordable as interest rates have fallen. So with this continuous price growth that's occurring, it's meant that the actual yield you're getting, if rents don't go up sufficiently, the yield drops. And that's what we've been seeing over the last 10, 15 years.
Well, what's ahead for us, John?
Well, I think what we're looking at is an abnormal situation. When I did this comparison in that article you referred to about the number of years it would take if you were able to collect all the rent you got from a property, how long it would take before it equaled the cost of the property that you bought. And to give you an example, during the Great Depression, rental yields were at about 25%. That's a rather horrific thing.
Amazing.
Yeah, if you think about it, it meant that a landlord could actually, if they collected all the rent, could pay for a house within 4 to 5 years. But that was an exception, of course. It was a terrible time. But at the moment, it's about 24 years. So if you collected the rent from a property, it would take you 24 years to pay off that property. And that's almost, double the long-term average.
Now, of course, that's not the reason that you invest in property. For most people, they do want cash flow. But in my mind, residential real estate is a high growth, relatively lower yield investment. But in due course, you do want to pay down the loans and you do want to live off the rents of your property. So you've got to get a combination of both. What do you think's in store for rents moving forward, John?
Well, I can see that our population growth rate is continuing at a fairly high rate of around 1.6%. 60% of those are overseas arrivals, and they have to rent for a number of years. So people coming here from other countries, moving to Sydney, Melbourne, and to a lesser degree Brisbane, have to rent for a number of years. So the rent demand is continuing to rise. We're seeing at the same time that the number of new developments is virtually stopped. So the supply of investor-owned properties is remaining static, but the rent demand is rising. And so I can see that rents are going to rise dramatically over the next few years.
That's great. But one of the things I've noticed is that there are some websites that talk about cash flow properties, and you can go to some of the portals and they can tell you the best areas to invest in for cash flow. Not that that's what I'd be suggesting anyone does, because when you dig into it deeper, there's good yields and there's bad sort of yields. Just because you're getting a good return doesn't mean it's an investment grade property underlying it, is it, John?
And that's right. And what they're really talking about is theoretical returns. They're looking at rental yield, and you can get the free reports quite often. They're published in various property media, and they'll give you the highest yielding areas in Australia. They are not necessarily good investments. And the reason they're not good investments is because prices have fallen dramatically over the last few years. And yield is a function of both rent and price. So when you look at those suburbs, you find that what's happened is that prices have crashed, and that's why the yields are high. So they're not really good cash flow investments at all.
Think about that. That's really got to do a lot with the mining towns, for example, and some of those regional areas that haven't got anyone wanting to buy properties in them. So the value of the properties have plummeted, but the rents have dropped a bit too, but not as much as the value of the properties.
That's right. And when you look at the number of empty premises, in those suburbs, you find that it's like 30-40% of the total are actually unoccupied because investors own them and they can't get tenants. So to look at the rental yield as the rent in a suburb compared to the price is a very misleading statistic.
Well, there's lots more that you've got to look at. So what else would you be looking at to choose an investment grade location?
Well, if I was looking for cash flow, I'd be looking at areas where the rent demand is strong and rising. And it's a very interesting example that I've used a few times. There's a place in Hobart called Risdon Vale, and it's got the highest rent yield in Hobart, but it's genuine rent yield. It's caused by rent demand. Now, when we went to Risdon Vale to find out exactly what was going on there, we discovered that it was the location of the maximum male security prison. In other words, that's where all the worst male offenders in Tasmania are locked up. And I thought, why on earth would anyone want to live in a suburb where there's, searchlights at night and the sound of howling dogs and so on? It's just terrible. And yet it's got the highest rent demand in Hobart. And the reason for that is it's the partners and the wives of the guys that get locked up in jail who want to live in Risdon Vale to be near their partners so that they can take the kids along on weekend visits and have conjugal visits. So the rent demand is really high, and that's causing the high yield in that area. So you look at, well, it mightn't be where you want to live, but it's where other people certainly do want to live, and that's why the yield is so high. So you've got to look at, well, is this an area where people want to rent, or what sort of people? And that is what cash flow is all about. When you look at growth, of course, what we find is that areas that have got really high cash flow tend to be the areas that have got growth potential as well, because once investors see that an area's got high cash flow, they want to buy there. So quite often, if you find an area that's got good rent demand, it'll end up being an area that's got good price growth as well. So they're the two significant factors.
Well, you need a combination of both, don't you? In my mind, capital growth occurs in general when owner-occupiers want to buy, because owner-occupiers are the ones that drive the markets, and investors drive the ups and downs, the booms and the downturns. But there will always be investors chasing yield. So there's not just one property strategy. It depends upon your stage of life, what your cash flow is, what your risk profile is. So therefore, you first of all, I guess, got to start with, what is your strategy? What is your plan? What are you wanting to get out of your investment? And then you've actually got to do quite some research on the location. So you're doing a lot of that, and you've got lindemanreports.com.au, lots of reports that explain what's going on. I know you go around on the ground and do your research as well, which I very much admire. It's very different from others who are doing it in their ivory towers in Sydney and Melbourne and don't actually get the feel of what's on the ground, because going out there gives a different perspective, doesn't it, John?
Oh, you find the most amazing things when you actually go and have a look, and that Risdon Vale is one example. Now, just on that subject, I would say if you were a startup investor and you're after capital growth, you wouldn't be buying in an area like that. But if you're a well-established investor and you're after cash flow, then they're the sorts of areas you look for. But we've seen some amazing things and seen areas that have got huge potential that simply slip under the radar.
So what in your mind gives an area good potential?
Well, I think if you're looking at right now, there's a very interesting thing that's occurring in our market, and that is what we call millionaire migrants. There's about 10,000 people coming into Australia every year from countries like China, the UK, South Africa, and they come in under this significant investor stream, which means they've got to bring $5 million with them. And they come in, and where do you think they move? They move to the upper socioeconomic suburbs in Melbourne and Sydney, where they buy property.
I would have thought they'd go to Risdon Vale.
No, they definitely would not. One area, unless they've been very bad, of course, they might end up there. But no, they would do the exact opposite. And so what we're finding is that price growth is actually occurring right now in these upper, the high quality areas in Melbourne, such as Toorak and Balwyn and Kew, and in Sydney, Mossman and Double Bay, those sorts of areas, showing a lot of growth potential. So even in markets where there's no overall growth, you can find growth potential if you're looking for, what's going to cause it.
Sure. So that's what I think I like about the way you do your reports, John. A lot of people look in the rear vision mirror and what's happened in the past, and it's not always a good indication of what's going on in the future. So like you, I like looking at leading indicators, looking at what economic drivers there are, what capital growth drivers there are with regard to wages growth, the demographics of the people, disposable income, and that's the sort of thing that I know you enjoy writing about as well. So interestingly, we've got some good times ahead. Capital growth is turning the corner. I think we can safely say that we're nearing the bottom. The downside is limited in Melbourne and Sydney, and the upside is actually quite positive. We're seeing that very much on the ground with our teams there, and so it's a good time. But I can't see a boom ahead. We're going to have a period of stabilisation as more stock comes on the market, John.
I think so. And I've also looked at what's happened historically with interest rates and, because they're now at historical lows, and booms or price rises tend to occur when interest rates start going up. It's really interesting. So I think if interest rates go up a little bit, that's a good thing, not a bad thing. And the reason for that, of course, is that if the banks are trying to secure deposit funds for investors to borrow, then they need a little bit more interest in to offer depositors in order to pay the investors, or not pay, or to charge investors. So at the moment, there's not much money in the market, and I think that's going to pick up over the next few years.
Well, the banks are in an awkward position, aren't they? They actually can't keep giving depositors less interest because that's part of the way they get their money to make the wheels of industry go round.
That's right. And what they do is, like any business would do, they look at which of their products is going to give them the most profit. So I think what they'll be concentrating on is, personal loans and credit cards and things like that, rather than trying to get people to take out home loans.
Well, that's a good point, because they do have to keep their shareholders happy, and they make a lot more. I don't think credit card loan rates have dropped much, nor have personal loan rates. So I can see why they'd be pointing in that direction. So thank you very much, John. We're going to have you regularly on the Michael Yardney podcast, and clearly we're going to have your regular blogs on Property Update. But if people want to know more about you, get your regular reports, get your blogs, buy some of the reports, they can go to lindemanreports.com.au. Thank you very much for your time, John.
Thanks, Michael, and thanks, everyone. Goodbye.
We're coming to the end of another show, but before you go, I'd like to say thank you for spending the time with me today. And twice a week I share my thoughts on the Michael Yardney podcast, and in between you can catch up with me and a whole heap of experts in property finance, tax, wealth, money at propertyupdate.com.au, my daily e-newsletter. And if you enjoyed today's show, if you got something out of it, please share it with somebody, because my aim is to educate as many people as I can to lift up our levels of financial intelligence, financial fluency. And if you could just click on the share button and tell somebody, that'd be really good, because I'd love you to help pass the message forward as well. And if you enjoyed the show, why not leave a review? Because that's another way of telling people what's going on, just like Mike Avery did. And I'm going to read out Mike's review in a second. And when you leave a review and I read it out, if you email me, michael@metropole.com.au, I'd love to gift you one of my books. And Mike's a great podcast. I've been investing in country properties for 15 years. I have a bargain mentality, which I acquired many properties. Unfortunately, they rarely go up in value, hence we struggle to find new projects. Michael has demonstrated a simpler strategy involving investment-grade properties. Thank you for sharing your knowledge. Kind regards, Mike Avery. Well, Mike, thank you for being open to listening, because, as you've suggested, not all properties are investment-grade properties, and it is just too hard to do it with cash flow type properties, despite what people will tell you. In the short term, you get a bit of cash flow. In the long term, you're not going to get the asset growth that you desire. But I'm going to give you one of my books when you email me your details. And I look forward to sharing my thoughts again with you twice a week on the Michael Yardney podcast. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?